How important is that inflation data tomorrow?
Morning, Brian. No coasting for you and I, right? Look,
None.
it's an important release. It is part of the broader set of data that we're dealing with right now, including last week's payrolls, the CPI this Wednesday, and of course the UMich survey on Friday. So there's a lot of important data, a lot to condense, but the markets are speaking with their feet. There's a risk-off tone in the short term. And that reflects the fact that the Fed's going to have to continue to be aggressive to tame inflation.
And by aggressive, you mean 0.75%, aka 75 basis points at the next meeting, probably a 0.5 or 0.75% at the September meeting.
Yes, Brian, we're looking for 75 and 50, followed by a couple more, probably 25 basis point hikes in the last two meetings of the year. And that's contributing to this dollar strength you were just talking about, parity with the euro, and a flight for safety, because the U.S. is going to keep moving rates up, which creates this interest rate differential and this desire to own dollars.
If that inflation data tomorrow comes in red hot, and I think the White House press secretary Karine Jean-Pierre said something to the effect of it's going to be, highly elevated or something like that yesterday, Mark. If we come in above 9 or something like this, does that make the markets go down because the Fed has to be more aggressive? And summarily, if we come in at 6, which is still historically hot, but far less than we are now, could that send markets up? Because then the thinking is maybe the Fed can sort of ease off the brake pedal a little bit.
Yeah, Brian, that's a great question. And I think it goes hand in hand with some of the other data we're likely to get. So, for example, we do think the consumer confidence data out from UMich on Friday is actually going to be a little bit improved because gasoline prices have come down. So to your point, if it's really hot and then we get followed with a more moderate UMich survey, the market could trade okay, because it implies that some of the impact from gasoline and from rent and from other factors may start to roll over that wouldn't have been caught in the CPI report. But as you also point out, if we get a much cooler number, then certainly people are going to, I think, read that bullishly from a risk standpoint, because it means the Fed won't have to be as aggressive in squeezing out growth.
It is very trendy to be negative on the American economy right now. I'll admit that in the media, everybody's tossing who can be the most negative right now. And every time we swing that far, I don't know, my little antenna go up, also known as my ears, and I think, have we swung too far? Is everybody now too grim reaper on the American economy?
Yeah, I think, you have to look at the economy and markets as two separate things, right? If you look back, Brian, people are quick to forget that we had 4 outstanding years in U.S. equities over the last 5. In fact, U.S. equities were the single best performing major asset class in the U.S. in 4 of the last 5 years. So we're down double digit in the first half of the year, but that's not the end of the world when you look at it over a 5-year horizon, anything but. So yeah, we've had a pullback in markets. We've had some air come out of the balloon, but that doesn't mean the economy is terrible. In fact, the currency markets are telling you, in fact, that the U.S. Economy is standing tall relative to global peers. And in fact, many of the concerns contributing to the sour tone in equities right now are related to Europe and to a degree China, not the U.S.